Less than a month after Luna burst to zero, events shocked the cryptocurrency field in May, and more projects emerged to collapse. Although Three Arrows Capital has been pushed to the forefront, a list of even larger cryptocurrencies, such as Celsius, Tether, Lido, and AAV, emerged closely to collapse. As of June the 20th, Bitcoin has fallen for 12 consecutive weeks, and reached a low of $17,593.20, while Ether has fallen in the same direction to a low of $878. Bitcoin has fallen more than 70%, from its high of $69,000, and Ethereum is at an 85th discount relative to its highest price. The entire total market cap of cryptocurrencies has fallen to less than $900 billion from its peak of $3 trillion in November last year. Overall, the cryptocurrency collapsed. And we are going to talk about how exactly did it all happen. Lingering around the collapse is a dazzling ecology and list of institutions, and the event is all related to the coin STET. Before we talk about STET, we have to talk about ETH 2.0 first. Ether is the key technical link in the development of blockchain to the actual application. Usually, people in the field call Bitcoin as the blockchain 1.0. Ether is 2.0. The underlying technology of Ether is the proof of workload mechanism. The disadvantage is that the efficiency is relatively low and transfer speed is relatively slow. With the rapid development of Ethereum, it is obvious that such technology cannot support more efficient applications, so Ethereum officials intend to upgrade from proof of work to proof of stake. Proof of stake does not consume too much electricity and energy for supporting the Ethereum ecology and expansion. Therefore, this upgrade is the most anticipated milestone for Ethereum since its inception. The first step of ETH 2.0 is to launch an independent network beacon chain that can reach a consensus. Investors can stake their Ethereum to the beacon chain as support for the system, and when the beacon chain and Ethereum are merged in the future, the pledger will get back the Ethereum and receive transaction fees and block rewards. This is a wonderful scenario. Not only can make pledges realize the benefits, but also bring a healthy result for the whole Ethereum ecosystem. Can a typical blockchain decentralized idea achieve ESO? It is said that there is faith in the cryptocurrency community, and the faith of newbies is also faith. Therefore, many people intend to participate in the pledged beacon chain to support their beloved God, bringing everyone on the road to wealth. But not everyone can participate in stake. First, you need to at least have 32 Ethereum or multiples of 32, so even though the price on June the 20th, 2022, was $1,000 per piece, you need $32,000 to participate. Second, it takes 27 hours to unlock your funds after the stake. Third, you need to have some technical knowledge and the ability to operate a physical validator node. These operations are too difficult for the common newbies can handle, so clever money and institutions set up stake pools. Lido is a platform that was established in 2020 to provide staking opportunities to small retail investors. You only need to have one Ethereum to participate, with an annualized pledge and return of 4%. At the same time, Lido will give you a certificate of STETH, and after Ethereum 2.0 has been successfully upgraded, you can use STETH to exchange for Ethereum 2.0. Everything is perfect, isn't it? Another problem with pledges is that as long as the main network, Ether 2.0, is not online for a day, it has gone offline 6 times. Pledges will be locked. Assets are meant to be liquid, so Lido opened a STETH ETH exchange pool on Curve to help customers who lost liquidity due to pledges. That's how Lido started the experience. Their business is also getting better, and better STETH circulation is getting more and more. Currently, there are more than 120 million ETH involved in Ether 2.0 pledge. Lido itself accounts for more than 32%, which translates to almost more than 4.1 million pieces. According to previously published data, the reality of locked assets on Lido is up to $18.3 billion. Lido's business is getting better and better, and it has become a wealth myth in the cryptocurrency world, triggering many participants, making up the pledge pool's base, causing the establishment of many lending pools, such as AAV, Uniswap, and of course Celsius. How did the bloodthirsty institution begin to amplify this situation? Investors who choose Lido to pledge to get STETH have 2 options. One is to sit back and wait for Ether 2.0 to come online to exchange back for new ETH, or to get STETH that can be exchanged on Curve to get liquidity. So lending platforms that also accept STETH to pledge, such as AAV and Uniswap, emerged, which formed subprime lending. As STETH can be pledged, which means it becomes an asset, so many institutions went to Lido to pledge and get STETH, then went to AAV and other platforms to pledge, which eventually made STETH and Ethereum two-way pledge. The operation is very simple. Pledge ETH on Lido to get STETH, then take STETH and then go to AAV and other platforms to pledge for ETH, get Lido to continue pledging, get back STETH and continue lending. If this cycle continues, the annualized return of 4% from the pledge C and reach 20%. As Lido forced the Anchor 1.1 exchange in the Ether 2.0 upgrade, many people decided that the risk was manageable, and so they all come in to invest. So can the dangerous game keep going? Does the music never stop? Celsius, a crypto lending platform, claims to have 1.7 million users, and on May the 17th the company had $11.8 billion worth of assets, with over $30 billion in Cheffy lending platform assets under management. This giant whale apparently has big holes in its management level, losing 35,000 ETH, worth $70 million, when its private key was lost in stake-owned Ether 2.0 pledge solution last year. The idiom of mending the fold has apparently never been heard by Celsius executives, so another loss of about 2,100 BTC and 151 ETH, worth over $50 million, was reported in the BadgerDAO theft. However, the institution deliberately hid the facts from its users and never mentioned them. The bigger loss was the process of investing in Terra, as Celsius promised customers a return of up to 19.5%. Attracted a lot of money influx, but Luna burst position to zero makes Celsius outflow of $1.2 billion. Capital outflow increased its run risk. What is worse, Steth off Anchor recently began to occur frequently. Lost and stolen events were stabbed out, and intensified investors apply for redemption of ETH. Celsius was forced to sell Steth at a discount in exchange for ETH, a large number of sales, and on June the 8th, the crypto whale withdrew 50,000 pieces of stethoscope in just a few hours despite the loss of slippage. Celsius could not afford to issue a suspension of embodiment, trading and transfer. Can Celsius withstand this? 3 Arrows Capital, 3AC, is a well-known cryptocurrency hedge fund with nearly $20 billion in assets under management and has invested in many projects such as Avalanche, Solana, Polkadot, and Terra tokens. First of all, 3AC's investment strategy and logic looks to be unbeatable in a bull market, but not so fluky in a bear market, especially with increased leverage. The institution first lost $559.6 million on their investment in Luna. They have since liquidated $70 of their $21 million worth of collections on the Superior platform. Secondly, according to Bitfinex data, 3 Arrows Capital ranked second in the May monthly loss chart on Bitfinex with a total loss of $31.37 million. Once again, 3AC's 223,000 ETH on Aave was liquidated, and $198 million in borrowings were liquidated when ETH fell below 1,000. At the moment, all is lost for 3AC. What about the future of digital currencies that will be hit by the recent crash? By sorting out the cryptocurrency market development and the problems of all the institutions that have been mined, we believe that the risk is huge, and the coin price is far from the time to bottom out. In the case of global liquidity tightening, the winter of cryptocurrency has come, but these problems will not blockchain technology constitute a blow, nor will they negate the development prospects of virtual currency. The upgrade of Ether and the pledge of ETH 2.0 are still no problem. If the upgrade of Ether is successful so as to support a larger and more efficient ecological application, this is a huge boost to the course of human history, and as for the future of digital currency, it should have a brighter future.
For more information, don't forget to subscribe our channel.